Hey guys, my name is Ruben, and in this video, I want to talk to you guys about something that we talked about previously last week regarding the NIO options and just in general the best things to trade during these markets. So if we look right now at the MNQ, which is the NASDAQ mini, we can kind of see how even last Friday, I think we had said on Power Trading Radio, or I'm sorry, on Trade with Merlin, that the market was likely gonna fall or retest on in the comment section back to as it closed higher on Friday. It would retest and pull back significantly at the market futures open on Sunday, as the banks and institutions would not want to get an aggressive move into the up move, and they would want to kind of close at the higher to try to get in, cash out some profits, and then inevitably unload some stuff with the low volatility and then get back in. And that's kind of what we're seeing here today right now. And so let's look at the S&P 500 at possible levels, because something that obviously we also know is the Federal Reserve and all the forces at play are currently looking at pumping a lot of money into the market. In a long-term basis, I feel like this is going to devastate the American economy, as the Federal Reserve will not find who to unload a lot of these equities onto. But with that said, nothing I say is a buy, sell, or hold recommendation. You can lose all of your capital or more trading and investing in the financial markets. This is simply for entertainment purposes only and food for thought, just to look at the general market. So one of the first things I'm going to go ahead and do is look at the biggest percentage move. Something that I always like to see is the way at any given day, really, what's up and what's down, because I like to see generally how the money is moving and how the different correlations may exist even within the S&P 500 within individual indexes. And then from there, I like to begin to look at the risk reward. So here we're seeing obviously a move of NIO up 13%, which is the one we talked about last Friday on my channel. And so we can kind of see the tech sector increasingly going higher. I do feel at some points, it's just my conspiracy for entertainment purposes only, that Tesla is going to eventually bid for NIO. I really feel that way, but I could be wrong. It's just an ideology. But we can kind of see the way Tesla and NIO sometimes fall in and out of correlation. And the reason I wanted to go with NIO is because I did want to go into the markets. I was bullish in the tech sector. I wanted to go with out of the money options because I felt like it was the best risk reward during the time, because the markets were uncertain. If they pulled back any further, I would lose even more money overnight, or because of the way they were positioned, any of us could lose way more money overnight with the markets being what they were during the March lows when I got into NIO. I also like the price points in which and where it was, and how cheap the options were in this particular company. I think I had traded all the way down to like $2 or so. So let's look at NIO during that time. And so I felt like the risk was just so low and the reward was exponential. I know a lot of people say that out of the money calls can be seen as gambling. I really don't feel that way if you're doing it on the right ones and the right assets per se. And this one is not a penny stock, and that's kind of what I mean. It's really not trying to go with the penny stock here, but yeah, I traded down really low here at $2.10. So with an out of the money call, again, they came down to like 15 cents. I think they're now what are they at now? Almost $2. Is the option. Again, I need to close out. I need to not show my positions, but again, this is not a buy, sell, or hold. I guess the average cost at bottom end was 27 cents. The current market value is 24. Again, it's a 10 to 1. You could have gone in a lot better than that. So really, I'm looking at the best risk reward within supply and demand ranges, and that during the time is what provided that, because of the sector I was in, because of the price points, and because of the way the options were priced for this individual asset. So with that, let's go back and look at the broader market. So let's look at the S&P 500. And so something that we can presume to see is likely a spike in COVID cases. We're likely going to see the market have a significant, I would have said a significant pullback. I don't think we're going to necessarily see one anytime soon. And if we do, it could be catastrophic for the U.S. Treasury itself. I feel like a lot of the retail investors are not necessarily trying to buy into this market. I do feel like it's artificially inflated. Again, that's just my opinion. So, but with that said, I could see pulling back to. So let's look at the daily. So I'm gonna cut this to a 4-hour time frame, and I'm gonna cut this. So that's daily. Actually, I'm gonna cut this to a hourly, and I'll have this be the daily, and I'll make this the weekly. So something we can kind of see here. Oh wow, the weekly is quite intense here. I guess we'll just leave it at the daily. Daily's fine. As we can see here, a lot of these major quarter zones are being tested, and again, it's kind of when we called the low of the market retest for the Nasdaq Mini at 73.75, and then kind of going on from there. I love the Nasdaq follows the quarters really quite well, and I do love that about it. So looking at the last move, I definitely feel like it would definitely test the 275 range. I would put an alarm at 275 to see the way it tested and whether it'll keep collapsing or if it begins to base and take off. So this is something that I would maybe cut in after drawing an alarm here. So let's just go ahead and walk through that process. Let me wipe these out because we don't need these anymore. Remove this trend line, remove this trend line. So something that I should probably done Thinkorswim to illustrate these charts, but something that we can kind of begin to see here is the way it kind of tested even here, that general buffer areas of the 270s area. And so again, buying options on the S&P 500, I think right now, actually they might be kind of deflated because we are in an upswing. So let's look at the VIX actually. Oh no, the VIX is up. But let's look. So if I'm going to look into, so the first thing I'm going to ask myself is what is the risk I'm willing to take? What am I willing to accomplish? So if my risk is only going to be a couple $100, then it definitely is going to be out of the money calls. If the risk is going to be, at least in these time frames, so the risk is going to be something a lot wider or bigger or a different account size, then we can look at the in the money calls. We can look at futures or the equities itself, although usually buying the underlier doesn't make a ton of sense in terms of risk, reward, and leverage, unless we're debating between an out of the money call or in the money call and buying it outright, in which case if you can afford to just buy it outright, just do that. Or buying a vertical put that'll give you a better break even than the current price. So the first thing I'm going to do is I'm going to go at the expiration at least 3 months out. And this is a 5K display, so I hope that you guys will be able to see this as I upload it. So right now it is June 15th, so let's go to July, August. Let's go to at least August, but probably September. Again, guys, you can always close them out early, at least in the US. So the current price is 303. I don't like it at 303, but if I was going to buy the call for 3 months out at 303, the break even is awful, I am sure. Yep, so then your break even would essentially be your target. Unless you're going to hope for a quick move on the S&P, which the S&P is not the place to hope for a quick move, at least not in my opinion. So we can look at the vertical put. So then if you sell the put here at 35, then your break even will be maybe exactly maybe even better than demand. What is this break even? So let's submit this. The break-even price would be, I always like to double check it. The break-even would be 264. So then we can look at possibly buying. Again, this is a very complex way of trading options, so I wouldn't necessarily copy this. I'm just trying to show the best risk reward for example purposes only. So we can consider doing a vertical put here, and then if the break even is 265, we can kind of see what buying the 265 around strike again. And you can be assigned, there's so many things that could go wrong if you're not proficient in trading this way. So I am going to teach more this option of trading, and again, in my opinion, it's so much more simple because you're literally just going by risk reward and what is the most beneficial to your risk reward, and your actual break even parameters. And so you're going just by break even. So in my opinion, it's a lot safer. But if you're going to look at the 260, Oh, yeah, it's so inflated. So then your break even there would be what to so if you're buying it at $23, then your break even would essentially be I have a couple of ways of calculating it. I could debit it from the risk, or but that's often it can be very confusing. But you can also just go by the break-even price of each, and then the mean would be where you're effectively controlling it. Again, because the markets are moving the way they're moving, I wouldn't necessarily be too eager to do this, but it would be somewhere around 240 something. So then it's kind of a 20 risk reward. So it could kind of balance out if you're looking to go long, and I will do a broader illustration of this probably on my Rubenanza.com or Capital Endeavor, again, because I feel like I don't want to overwhelm the YouTube audience. So there's not I don't feel like there's really a trade in the S&P other than the alarms right now and setting them there and then looking at the arrival of when it hits those particular areas. With that said, out of my favorites right here, I am alongside bias. I just prefer to go long because shorting right now or shorting historically has can work, but it can also get short squeezed. And historically speaking, if you miss the biggest rallies, even during from 95 to 2005, if you miss the 10 best days, statistically speaking, from what the Molly Full article I showed before, you can cut your long-term gains by from like 500% to like 191. So it's quite a substantial risk there in missing out the up moves if you're essentially alongside a bias, and I feel like it's usually the better way to go. I feel like if I was going to go short, I could consider if I was going to look at the at shorting possibly buying the put and then maybe dumping it around this. So actually, let's look at that. Let's look at how much the buying the put would be at around where we would want to own it. So let's look at 275. No, it's awful. Yeah, no, might as well buy it outright. Yeah, I guess we can look into weekly options, but I'm not too crazy about those. Let's look at something that maybe pulling back. Actually, let's look at what Boeing's doing. Do I have Boeing on here? See, this is something that we find interesting, right? Because we can look at all of the news and all the semantics of why things may not be recovering the way they should. But and I'll probably here begin to unload some of my NIO position because at least maybe like a third of it. Again, out a buy, sell, or hold recommendation, and I just want to show you guys do like a quick market overview. But the fact that Boeing hasn't recovered, even though with all the money going into Wall Street and the fact that they turned the money down, I think that could be an actual indicator of the realistic conditions, or the more, I think, realistic conditions of the market due to the way that the Boeing does a lot of the government contracts and the way that correlation stands, in addition to being such a big part of the overall market. So if we look at the Boeing calls right now, let's see if we were to go back to these levels of 300, what would the risk reward be? Although the next, I would say the next area of supply here I would want to look at would, now this is so choppy, I don't really like this. It would be all the way up here for like some going to heaven. No, I don't really love this. Again, not that I'm sure we could find a trade, but not one that I like I said, and like I always show you guys, I like my 10 to 1s and not being bothered thereafter. But just for, I guess, purposes of right now, let's look at, oh, actually, look here. Here's a great example, again, of the quarters kind of doing their thing. And like I said, I do like to correlate quarters with supply and demand, especially if I'm looking to like refine things. So then, how did we get the 8-hour chart again? Let's cut this to let's get this to a 4-hour. I'll use Thinkorswim next time for you guys. I love Interactive Brokers, is my favorite platform, but I don't think it may not be the best for the kind of examples that we want to showcase. And for the 4K displays and all that. So When was the last time I was there? Actually, let's unlock. Let's unlock this and let's just close out these charts. Oh, actually, I do like this lock again. I do like the way it kind of, so then let's go down to an hourly. And at this point, I'm looking for a flip on the hourly for this area that already matches supply and the quarters. Oh, see, so, okay, so if I was going to look at around here, I would look at the way this can kind of take off. So I would hope for it to clear, this at around 252 from 248. So, and I guess why not? Let's really look at supply and demand here. So let's go to the 15-minute. And at this point, we're looking at pattern formations of what happened during that time. And again, we're thinking of buyers and sellers. Okay, so then we can refine this. So new buyers came in and then they took off and then they just fell off. So I would look for a clearance of 252. What is it going to be? 55, 54. And then maybe looking at buying out of the call money, out of the call options there. And the reason why is because in the money, it could keep falling. Again, a vertical put, again, it could keep falling and there was reward. And here, if it clears this, and because of the way the time dilation is working, the way the markets are moving, if it happens, it could happen quite quickly. Let's look at what you guys, I don't like this. $15 over 250. What is that's 265. Do we like it at 265? I'm gonna say no. Actually, you know what? No. Not for me at least. At the 250, if we sell the puts, again, this is you want to proceed this with caution. I'm just going off demonstration purposes only. If you guys are interested in learning this, you can DM me. But selling that will give us a break even. Actually, give us a break even of below current price. Like what is it, 175? But then give to 80. Yeah, there's not great trades right now. Like I said, I'm pretty firm on just looking at out of the money calls and things that are not as inflated. So it could be lower priced assets like a NIO, and like we said on Friday, which if you bought in, you would be up quite substantially. The options, at least, it went from the options are up $700 over. Yeah, you could be up like 50% on that from when we spoke about it last Friday. Oh, I do like T-Mobile. Oh, I remember I had T-Mobile at $64. Again, this market's amazing for options, but a very particular style under very particular market conditions. So I want to walk away with at least one trade. I would say I would maybe consider. No, I don't know that I would get into NIO right now either. Not the options we already bought into. Let me know if there's something you guys want me to analyze, and I'll do it live next time. But I feel like right now there's nothing great. There's just nothing great. And no trade is a trade, guys, remember. But if there's something you want to look at, let me know in the comments. And I hope this was helpful, and I will see you guys next time.